Hi. Let's learn about flexible spending accounts, FSAs. A flexible spending account is a type of savings account that provides the account holder with specific tax advantages. An FSA is sometimes called a flexible spending arrangement and can be established by an employer for employees. The account allows you to contribute a portion of your regular earnings before tax. Employers also can contribute to employees' FSAs. Distributions from the account must be used to reimburse the employee for qualified expenses related to medical and dental services. Another type of FSA is a dependent care flexible spending account, which is used to pay for childcare expenses for children aged 12 and under and also can be used to pay for the care of qualifying adults, including a spouse, who can't care for themselves and meet specific Internal Revenue Service (IRS) guidelines. A dependent care FSA has different maximum contribution rules than a medical-related FSA. One of the key benefits of a flexible spending account is that the funds contributed to the account are deducted from your earnings before taxes, lowering your taxable income. As a result, regular contributions to an FSA can reduce your annual tax liability. The IRS limits how much can be contributed to an FSA each year. For medical expense FSA accounts, the annual contribution limit per employee is $3,050 for 2023. If you are married, your spouse also can put aside up to the annual contribution limit through their employer. Employers can choose to contribute to an FSA, but they don't have to. If they do, their contribution doesn't reduce the amount that you are permitted to contribute. You aren't taxed on employer contributions. For 2023, the contribution limit for a dependent care FSA is $5,000 for joint and individual tax returns and $2,500 for married taxpayers filing separately. Besides their tax benefits, FSAs offer several advantages for account holders, but they don't cover all manner of medical or dental expenses. The Coronavirus Aid, Relief, and Economic Security Act enacted in 2020 expanded reimbursable qualified medical expenses for 2020 and later years to include the cost of over-the-counter drugs without a doctor's prescription. The act also permitted the use of FSA funds to reimburse the costs of menstrual care products. Both these CARES provisions are permanent. When the year ends or the grace period expires, any funds that remain in your FSA are lost. Thus, you should carefully calibrate the amount of money you plan to put into your account and how you intend to spend it over the course of the year. A different type of FSA, a limited-purpose flexible spending arrangement, refers to a savings plan that can be used with a health savings account, HSA, which isn't allowed for a standard FSA. Contributions are made using pre-tax earnings. A limited-purpose FSA is more restrictive because the arrangement is reserved for paying dental and vision expenses and sometimes other costs incurred in a high-deductible health plan, HDHP, after the plan holder meets the deductible. No specific amount is correct for everyone, and FSA elections vary depending on each individual's particular situation. Make your election by carefully examining your expected medical and dental expenses for the upcoming year. If you expect to have minimal healthcare expenses, you may want to reduce the amount you contribute to your FSA. You can use funds from your healthcare FSA to pay for eligible medical costs for both your spouse and tax dependents, regardless of the medical insurance in which they are enrolled. A flexible spending account lets you set aside a portion of your earnings before tax for medical and dental expenses. It's established by an employer for employees. Employers also can contribute to employees' FSAs. Distributions from the account must be used to reimburse the employee for qualified expenses related to medical and dental services. Another type of FSA is available for dependents' care. There's a maximum contribution limit for individuals each year, and most of the money must be spent in the calendar year it's saved, so FSA account holders need to carefully plan their contribution amounts to avoid losing unused funds. Here are 4 key takeaways. 1. An FSA is a type of savings account that allows employees to contribute a portion of their regular earnings to pay for health-related costs. 2. Funds contributed to the account are deducted from earnings and aren't subject to income and payroll taxes. 3. Funds withdrawn from an FSA to pay qualified medical expenses aren't subject to tax. 4. The money in an FSA must be used by the end of the plan year, but employers can offer a grace period of up to 2.5 months, through March 15 of the following year. Hope this would help. Thanks for watching.